Well, to be honest, you would have thought that gold would be the asset class you should be looking at because typically we view gold as, I guess, one of several things, either just broadly a hedge against an economic downturn, but specifically either a weakening dollar or increasing inflation expectations. And what's been odd about the rally in gold so far this year is it's actually moved in the opposite direction. We've seen inflation expectations fall significantly since the outbreak of the pandemic. That's what's behind the fall in treasury yields, for example. But yet we've had this massive rally in gold. And what was interesting last week, when you had another sell-off in treasury yields, partly the surprise on CPI inflation, partly a somewhat disappointing auction for long-dated treasuries, gold fell 4%. So that correlation's broken down. So if you want to find a hedge for inflation, you need to think about whether or not gold really is that hedge the way you might have thought it was in the past.
Absolutely, but there's an element of boil the frog slowly about this story. I mean, what do you see over at BNP in terms of the year-end level for the 10-year Treasury yield? Because if we can predict that, I think we can figure out an awful lot about what happens to equities and gold over the next few months.
Yeah, well, if we can predict the Treasury yield, I imagine we'd be doing something else. Our expectation is that Treasury yields are probably not going to be wildly different from where they are right now. Given that we've already hit 70 basis points, 70 to 80 is actually probably around a level we'd start to think about going long again. To try to get much beyond 80, you do have to have a view, either a much bigger acceleration in growth, which certainly seems unlikely, or a surge in inflation or inflation expectations. And while you can create scenarios where that's plausible, it's not our base view. We still think that fundamentally low growth is going to keep inflation under control. We're in this lower for longer environment for an extended period of time. That said, we don't imagine we're going to necessarily get back to the lows we saw earlier this year because, by and large, at least in the U.S., the economy is managing living with the pandemic reasonably well, especially now that we are seeing infection rates and hopefully death rates start to fall. So I think we are kind of in the range we're likely to stay in through the end of the year. What does that mean then for equities? It's still supportive, and it is a bit unsettling perhaps to use the term again, but it is a bit returning to a Goldilocks environment of perhaps slightly slow but steady growth. It is going to be a recovery, low inflation, and massive support from the central banks. That's been good for equities in the past, and we broadly think it's going to continue to be so.